Greetings, I'm Tim Profeta. I'm a senior fellow at the Nicholas Institute. We are in the last sort of provocative session of the day. And what we wanted to do here was we wanted to sort of think about the themes and the threads that came through today, and then think about a provocative idea: how do we answer the call for the need for climate finance? It's been a heck of a day, but as I sort of would say, I think a couple themes that came out of the day is a continuing need to deploy at speed clean energy, climate solutions, and energy for our competitive needs, as we heard about in the last panel. A sort of challenge that we heard, I think Megan was talking about the missing middle, it's in our title, or the valley of death. These technologies that both bump up against the need to get investment to improve their technology and bump up against the need to finance themselves, their first of the kind plant and at a high capital level to demonstrate their technologies. Having been here last year we had this same conversation on this stage. We had it with a lot of people from the US government and talking about how the US government might be a party to help things get across that valley and to demonstrate deployment. This year we've sort of heard the challenge of, let's just call it government uncertainty and slightly chaotic situation with what incentives will still remain. So what we wanted to do with our panel was sort of pose the question of what other structures, what other financing constructs could address this challenge? We heard about it a lot through the day. I was thinking about Peter Smith talking about he's willing to invest in proven technologies, but how do you get to be a proven technology if you can't get across that valley of death? David Crane said if he was a CEO of a company right now, he'd be sitting on his money, so we can't expect David's successors to be deploying capital at speed. So who does take the technology to its first of a kind demonstration and then forward to its nth of a kind demonstration? I want to sort of pose really two fundamental questions to my colleagues here on the panel, and I'll introduce them briefly in a second, but I'll let you all contextualize your introductions as well as you begin to speak. Eric Toon on one of our panels said we really need a new type of capital construct. There's plenty of capital in the world. We have to have a new construct to get that capital deployed for these solutions at times. So what I first will ask is, where will this come from? Can we create a concept with philanthropic, concessionary, blended stack capital that could do this? And in this, I'd ask you first to say, what is the problem we need to solve? Have I defined it sort of correctly for you here? And has it changed since January 20th? And do we have new problems that need to be solved since January 20th? And then second, what would you provide? Let's ask you to sort of throw out like what you would provide as your solutions. I've got three great colleagues here to explore this with. Chip Dunn on the end from Monomyth Group. It's the CEO and founder of Monomyth Group. Has invested in technologies and companies across the entire spectrum of capital. And I think Monomyth is sort of dedicated to all the way from VC all the way through the infrastructure, but also has a really very relevant experience with the company you're really working largely with, which is Novion, a domestic graphite manufacturing company. Rebecca Kasper is with us. Rebecca just stepped down recently as the Chief of Staff for the Loan Programs Office at DOE. And last year we were here with your former boss, Jager Shaw, talking about how this could be the solution to some of these topics. And I think Rebecca will carry a lot of experience of what worked and didn't work at the LPO. And Jason Scott here is a partner at Spring Lane Capital, and a good Duke citizen, teaches climate finance undergrads here at the university. And also actually one of your partners at Spring Lane is sort of one of the people who writes the most about this missing middle, Rob Day, and how do we fill this gap. So let me turn to my panelists. I'll start with Jason and move on down. What is the problem to solve? How would you? I'll tell you what. I'll start with Chip.
No, I can do it. I'm good.
Start with Chip. Start with Chip.
All right, you got it?
It's okay. Well, first of all, you said we could start with a provocation. So
yeah.
My provocation, that was not a foul on Cooper flag.
What? I don't even know what he's talking about.
Football game.
Not enough discussion of basketball today. I was counting on coming down here and bringing back my national championship T-shirts. Kids are very disappointed.
I was really looking forward to talking about that for most of the introduction.
Day of mourning. Yeah. You were wearing all black on Sunday when we did our call, so.
It's true.
I'll start with that. No, look, I mean, I think that, well, first of all, thanks for having me. I do teach here. I have some students here. Thank you for coming. Class again soon. But we, at Spring Lane, we've been focused on this missing middle for a long time. But I think what's really important for everyone to understand, or my personally I'd like to share, is that even before Trump was elected, there were gaps in the market that weren't being filled by private market players, either commercial capital, concessionary capital, philanthropy, et cetera. And so I think if you look at the policy environment, we did have an LPO that was helping fund big credit-worthy entities and catalyze capital there. We had someone here earlier from the Office of Clean Energy Demonstrations and there are lots of grant programs in DOE and around government. And we actually created something called the Greenhouse Gas Reduction Fund, GGRF, which was providing catalytic capital going to provide catalytic capital for proven technologies, right? But there was always this gap in the middle around growth equity for emerging climate technologies, project finance for higher risk climate technologies, and then kind of I'd call it like the first equity, the highest risk equity for proven technology projects. So we had some companies here today that are kind of in that missing middle. End cycle is one. Fervo's kind of hopefully getting through the missing middle. But we had gaps before that I think private actors, I'm also on the board of a nonprofit called CREO, Family Office Network. We wrote a report on kind of these gaps. And we have been trying to get private actors to step in those gaps for a long time. It had been very clear to Spring Lane and from a CREO perspective that we needed some combination of government, family offices, insurance companies, pensions, other private actors to step in to help catalyze capital into those gaps before the election. I think maybe I'm not going to go into what happened since the election. The only thing I will say is listening to obviously David Crane, but also people like Peter Smith and Will Demas talk about what they can do. They need to do commercial deals. The current market environment, and every single panel, I don't need to repeat it, nobody's investing money right now in things where there's even the slightest risk of demand destruction, price increases, or policy uncertainty, which means a large part of the clean energy economy. So I hope at the end of this panel we get to the call to action, which is figuring out how people in this room and people we know, what mechanisms can create to close those gaps, some of which existed before the election, some of which existed after, and even more will be created as we see the destruction from tariffs and whatever happens to the IRA.
Great.
Yeah. Thanks. Thank you all for having me. I'm really grateful to be here. I kind of would like to touch upon, I was in the federal government for the majority of the last administration, and there is so much that can be done with the power of the federal government when it comes to as David Crane said, he was blown away by the talent and intellect at the Department of Energy. And you just have so many resources at your disposal. And so that was a huge, from the Loan Programs Office, we were able to use that to kind of diligence the best projects and that kind of collective intellect. So that, this is kind of a little bit of a boring answer, but I wish we had just had more time. The IRA and the bill kind of gave us the resources to really switch DOE from a fully research agency to one that commercializes projects. And we kind of were getting there, and we just needed a little more time to then reform NEPA and permitting and NEPA reform so that we really could fully kind of the government could be that catalyzing force in the investment space. So now it's kind of just what will fill that gap?
Well, hopefully you have some solutions to be provocative. But Novion Technologies, which I'll focus on, which is one of our largest investments and where we're leading the investor group, is a battery-grade graphite, synthetic graphite business. And for those who don't know, if you haven't read the papers in the last few months, or in the last few weeks, about 97% of synthetic graphite is produced in China. So although we were certainly a big fan of the IRA and the BIL and the last administration, we're probably one of the few companies that probably presented something today that actually really likes what's happened in the last few weeks. Because Chinese graphite today, with the current announcement this morning, would be about 150% tariff, which oddly enough still isn't enough. We actually had to file a trade case right before Christmas, and our dumping margin estimate was 921%. And when the ITC did their math, we weren't crazy. They came back with 915%. So we all want cheaper batteries. We all want to have batteries to power all these things that we want to be doing, whether it be the load growth or electric vehicles or whatever. But just because we've gotten seduced by cheap graphite or cheap materials coming from China doesn't mean that that's the right thing for America. And so we, funny enough, are working quite closely with the current administration on how they're thinking about repurposing the IRA to the extent that they can and leverage some of the executive orders. So I do think that a lot of the things that we all care about, quite frankly, are going to be repositioned, maybe not exactly the way they were all written in the various legislation, but I think the capital is still going to be there for a lot of these projects because they're all, just the narrative is changing. Rather than being about electric vehicle adoption, it's about national security. And so that's, I think, the thing that, if I take away one thing from the last few weeks and the last few months, it's actually, sometimes you have to pivot your business model just in the narrative alone so that you can actually continue to access the great work that Rebecca and her team was doing at the DOE and other government places. But I guess really quickly, and I know Tim has some other questions he wants to get to and some solutions that we hope that we can explore, without getting in 2 minutes or less, 150 years of history. If we were having this conversation 100 to 150 years ago during the second industrial revolution, the source of this capital would have been Carnegie and Rockefeller and Ford. And much to all of our dismay, none of those three actually invented the things that they did. They were all proven technologies that they were just improving upon. And yet today, the challenge has been that the private markets in particular, the public markets for sure, have a much shorter duration, much shorter hold period perspective. And so when we think about solutions, it really starts with, these projects take a long time. No matter what happens tomorrow, it's still going to take us 2 years to build any sort of capacity that's going to be meaningful to the United States battery supply chain. And so, so that capital has to come from a source that's willing to take, on the one hand, early stage risk, not necessarily traditional technology risk, but early stage risk, because it takes us 7 years, up to 7 years, to get qualified into a battery because we all care about those batteries not blowing up. And so, although it's technology that 100% of the capacity in China is using today, it doesn't mean that we can just say, hey, we're now in business because the Chinese do it. We have to prove to the customers, the OEMs, that we actually know what we're doing. And so that's for all of our benefit. But again, we can't just snap our fingers and have this built. And guess what? It takes a lot of power. It takes 150 megawatts just for just for one facility. So we have to have, we're competing with data centers for all those great sites for OpenAI. And so at the end of the day, I come back to finding capital sources, especially for the equity. We're a recipient of a great award out of the DOE, our grant, 100 million plus. We have a $400 million LOI from the Export-Import Bank for project financing. These are wonderful programs. But the problem is actually getting the risk capital, real early risk capital, the equity capital to support all this stuff. Because we're not talking about a $400 million LOI to support a $450 million project. It's $1.2 billion. So I've got to find some more equity capital that's willing to take some risk along the way. And in my experience, at least, those with the longest hold periods are probably more likely to what Jason was saying, the families, the endowments, the insurance companies, et cetera.
So I'm gonna jump off right where you left it. Let's go towards our solution question. So I think we've sort of diagnosed that there isn't long tenured capital really in the sector sufficiently now. I think there's a risk tolerance, and then we sort of started pointing at there are endowments and family offices. I'm still thinking back to Eric Toon saying there's a lot of capital in the field. It's just not structured correctly. We walk out of here and we find several family offices and several other endowments or others that want to structure a program to address this missing middle. How would you structure that program? What would you build? What would you tell them to build to address the issue we're talking about here today?
I'll say two things quickly first. So we did say we were allowed to disagree slightly on the panel. So Chip said something really important though, which is I do think that there are ways to reframe and repurpose, and I've been at the Capitol Hill with David Kilpatrick and a bunch of others here, like competitiveness, bringing manufacturing back, resilience, national security. So I do think there is the opportunity to reframe, but I think fundamentally the policy environment and the effectiveness of the current administration is going to be so hard to predict. How about that? That investors aren't going to count on it. So I do think there will be dribs and drabs, and there will be companies that benefit, and there will be sectors that benefit. You know, Nat was saying carbon capture and storage. You know, maybe it's batteries, maybe it's something, but I don't think that will replace the policy certainty that we have. Number one. I think number two, since I'm on the board of a family office network, you know, the thing that is really challenging here all the time is the billionaires need to save us. The billionaires, like, they're not saving us. Especially right now, they're definitely not saving us, right? But I do think that family offices can be a catalyst to get other institutions to think longer term, right? And I think Chip's exactly right that a lot of these solutions, there is theoretically a pot of gold at the end of the rainbow for these solutions. They're cheaper, more secure supply chains, all kinds of distributed generation solutions, things like enhanced geothermal, right? But there is a longer time frame, so there is a duration problem. And I do think where families can help lead is kind of catalyzing pension funds, catalyzing insurance companies, catalyzing all kinds of other sovereign wealth funds, whether they're still willing to invest in the US, a bunch of them still are, obviously, to invest in these sectors. The way I would do it, and we did say we come up with some specific things, which are things to take pot shots at, right? But you know, we did some math at Spring Lane around a specific problem for the first of a kind technology financing gap. So these are the first commercial facility, right? So something that's been done in a lab, never been done at scale. Maybe it's a 20, 50, 100, $150 million facility. You can bundle together that risk by having a fund or a platform do 10 or 15 projects. Maybe you have $1 billion or $2 billion fund. But as we were saying before, sometimes I think nobody's ever read The Big Short. If you put a bunch of crappy projects together and you call them AAA, they're not. They're still crappy projects, right? So, but if you had a concessionary capital layer, like the folks from BlackRock did, like Altera is doing in their funds, either cheap debt, first loss capital, or a capped return on your capital. You know, if you had a 10% layer in $1 billion fund, you know, our guess is that math probably works to get the commercial capital to a commercial return for the given risk. So $100 million catalyzes $900 million, creates a bunch of new first-of-a-kind plants. Not all of them work, but if 1 or 2 of them work, that can return the entire fund because these are breakthrough technologies. So that's something, you know, we were talking to policymakers about before the Trump administration. Now we're talking to family offices and pensions and sovereigns about now. But to us, that's a practical way to move forward. The last thing I'll say before I pass on to the other ideas is, I would definitely like to leave the day with a call to action to help Nicholas and Duke figure out, we need a lot of data. We need to do a lot of analysis. We need a lot of case studies. We need a lot of market studies. We need to take the lessons from emerging markets and things like DFC and OPIC and XM to show that you can make money provide with concessionary capital, even with extreme risks from emerging markets and technology risks. And I do think this is a group of people, and this is a time where we should support that research, because no one's just going to show up and fund it. We've got to present data, options, and structures for people to invest in to catalyze this more commercial capital.
Go ahead.
Do you want me to go?
No, please.
I think I might have forgotten. Sorry about that. Talking with my hands too much. I agree a lot with what Jason said, but one of the things I learned working in the federal government and what was so catalytic about our investments is they were motivated by greenhouse gas reductions. They were motivated by the mitigation factor, not by rate of return and how much the highest short-term return, the profits. And so you really could make those investments where it had the biggest impact on moving clean solutions forward. So I'm not the finance expert, but I think whatever it is that we create, the first principle needs to be focusing on mitigation, driving clean solutions, decarbonizing, and then go from there. So kind of look to everyone else, that being the first principle, how could we structure this fund with that in mind? And it still can, I'm sure it will still drive returns, but that won't, the returns won't be the driving force behind the investments.
Well, first of all, I think we heard all throughout today, at least a half a dozen, and I'm trying to think about who exactly they came from at each point, but at least a half a dozen different versions of what we're talking about.
Yeah.
And whether or not those have been successful, I haven't done enough research yet to know if that's the case, but I imagine that as Jason is saying, if we can actually collect this data and see what did work and what didn't work, I think there's a solution in here that can get us over the finish line. But I guess I'd say that, funny enough, even though we are a recipient or certainly a user or a wanter of government capital, I feel like half my time thinking about ways to de-risk my own capital structure so that I don't actually ever need government capital. And it's certainly failed so far, but I'm trying. But nonetheless, I guess I have two ideas to kind of throw out there that are, and maybe there's as we germinate this. One is utilizing the tax code as it is, or as it might change, to really incent, whether it be incent investors or individuals or both, to make investments into either charities or foundations or both, where those entities could actually be the catalyst of taking some of this risk on a much more tax efficient basis for the investor on the one hand, and potentially maybe with some form of government intervention or support on the other hand, where maybe the charity's matched, for example, but the donations matched by the government or something like that. The other one is probably more practical and actually takes the pressure off of all these longer term sources of capital that we're talking about potentially, or maybe it complements it. And that's actually thinking about the upstream, or really the downstream customers of all these various markets that we're trying to shore up, and looking to maybe the government to help support investments into those end users, which are far better credit profiles than we are. And maybe those funds can be used either with private capital or discreetly into all these various initiatives to de-risk those early, especially that seed to folk kind of process. And that way, the guys who are actually going to be giving us the offtakes will ultimately benefit probably more from their investment return if we win than they are going to have to pay an extra $300 per car for a little bit for the graphite because it's more expensive if it gets sourced here in the near term.
Can I add one more thing?
Of course.
Another idea we kind of were talking about in all of our preparation for this is the fund we're talking about of blended capital, concessionary capital, whatever. The loan or what it would be is still the funding of the project, whether if it's equity or loan, whatever it is, will still be done by a commercial bank, but this fund would guarantee it. And that's actually something that the Loan Programs Office did as well, but by doing so, it would then lower, well, I guess if it is a loan, it would lower the rate and make that capital cheaper.
So first of all, let's take up Jason's call to action. Part of our hope in this panel and this conversation was, having heard the conversation today, let's not just have a conversation here today. Let's make something actionable out of it. I think, Chip, you're right. I think we heard like 6 different themes on blended funding constructs people have made here today. We heard 7 different examples of frustration of gaps in the climate finance sort of stream, and so I think we will, at the Nicholas Institute at the university, take on this question. If we do, and maybe I'll, let me ask all three. If we do, what is persuasive? What is the data that we need to crunch? What is the case we need to demonstrate to make this persuasive to one of your families or a sovereign fund or whatever that you think could actually, attract the investment?
I think there's 2 pieces of data. One is, I think, historical data, which is available, and CREO just did a report on financing gaps for climate solutions. I think there is data that shows that a lot of these segments of the market have returned the same or better than other ways you could have allocated your capital over the last 10 to 20 years. But I think you'd need to get much more discrete with that data. That data is not very good at analyzing projects. So a lot of it's on kind of equity, a lot of it's not about project equity or lending, and so I think there's a part of the market that hasn't been explored. And the second thing is I think you could do some real kind of back testing, almost research on kind of if-then statements. The brilliant thing about the GGRF, Greenhouse Gas Reduction Fund, which I hope people will see eventually works, is that if you tell someone, if you think you have an 18% cost of capital and someone gives you 7% money, you're going to do that deal 10 times over, right? And I do think there are real rates of return that you could use to pencil out projects to show that if you provided money at this, you could catalyze this much money commercially. And so I do think there are real projects, real models you could go get from real investors to show exactly how much money you could catalyze depending on the cost of the capital you're willing to provide. So those would be my 2 ideas.
You want to go first?
Not to oversimplify it, but I actually think you just take a page out of the venture capital playbook. And even though it's a much bigger number, if we were talking about projects, if you take a portfolio approach to this, even though a project might be $1 billion or 200 million or whatever it might be, in our case, of course I've eaten the cooking long ago, but what we're estimating it to the equity investor today could still be a 20 to 30x. And if we're right, and you take a portfolio approach, you only need 1 of those in the portfolio to justify this massive capital spend across 10 or 20, whatever it might be. And so I actually think it's actually pretty simple. It's just a matter of actually finding that capital base that's willing to take the same kind of venture type risk with this type of asset class.
Yeah, just kind of showing that if, the capital, it's concessionary capital or it's willing to take the risk, find the data that shows that there is still a return in the long run. There is still a path to make money.
I think we are almost out of time, but let me just ask this. I'll do a lightning round, and the lightning round question is really, I think in conversations we've had about this, there are those, you said the billionaires won't save us, right? There are those who say this is great, but we don't see these sources of capital stepping forward. So the lightning round question would be, what's changed? Why do you think this sort of proposal might work now?
I mean, I think what's changed is JP Morgan and Morgan Stanley last week both came out with reports to say we're the world's burning, right? I mean, they were not saying that 4 years ago, right? I think the data is overwhelming from insurance companies and authoritative sources in the capital markets. And it's just like anything else, compound interest, any other kind of growth rate. Like, if you do this for 2 or 3 years, like, we're cooking even faster. And I do think that nobody ever almost nobody ever argues with anyone anymore that we have a climate crisis coming. I think what people haven't started to internalize is how much more screwed we are if we just slow that growth rate down for 2 or 3 years. Like, the compounding effect of 2 or 3 years of negative growth or flat growth is astonishing, and we all know that. This is fuqua. So,
What's changed?
What's the alternative? What is the alternative? We just stop? We just burn,
Yeah.
burn up.
Chip?
I mean, what's changed? I mean, guy with the really bad hair has changed. I mean, again, I come back to changing the narrative, at least, at minimum. Maybe changing your pivoting on your strategy and finding what does work for the next 3 years, so that rather than fighting, the police, we can actually work alongside the police.
I'll do the one side of the street, you do the other.
Perfect.
I think we got a partnership built here. I was just told our time is up. I knew this would be a quick half an hour, and it was a very quick half hour. But again, we wanted to do this because we wanted to try and sort of surface and capture some of the ideas from today. And I think what I would put the invitation out to all those who are friends of Duke here is like, we'd like to actually try and develop this and have an idea that we could actually think about pursuing.
Fantastic.
And I really appreciate the 3 of you being thinking partners on it.
And you have a guinea pig.
All right, exactly. Wait, first money.